Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 2 of Unlocking Options Trading, understanding Delta, Gamma, Theta and Vega. Vega, the sensitivity to volatility. Vega is one of the key Greeks in options trading, measuring an option's sensitivity to changes in implied volatility. When traders talk about Vega, they refer to how much the price of an option is expected to change when volatility increases or decreases by 1%. Understanding Vega is crucial because it helps traders anticipate market shifts and adjust their strategies accordingly. Calculating Vega. Calculating Vega involves a specific formula, but understanding the concept is just as important. Generally, a higher Vega value means greater sensitivity to changes in volatility. Here's a simple way to think about it. Formula: Vega equals change in option price, change in volatility, x 100. Example: let's say you have a call option with a Vega of 0.25. If the implied volatility of the underlying stock rises from 20% to 21%, the option's price is likely to rise by 0.25. 1 equals $0.25. If you bought the option for 5, it would now be worth 5.25. In real-world trading, Vega plays a role whenever significant market events occur. For example, if earnings reports or economic announcements are on the horizon, traders often see spikes in implied volatility, affecting option pricing. If you know the Vega of your options, you can position yourself to benefit from these changes. Using Vega in trading decisions. Understanding how changes in implied volatility affect your options can guide your trading strategy. Here are some points to consider. Increased volatility. If you anticipate a rise in volatility, buying options with high Vega can be a smart move. These options will increase in value as the market becomes more volatile, boosting potential profits. Decreased volatility. Conversely, if you expect volatility to drop, consider selling options with high Vega. As implied volatility decreases, the value of these options will likely fall, leading to potential losses for holders. Market conditions. Always take market conditions into account. If the general trend shows stability, implied volatility may decrease. On the other hand, uncertainty can cause volatility to spike. Time decay. Keep in mind, Vega can change as expiration approaches. Options lose value over time, known as theta, and understanding the balance between Vega and theta is key to successful trading. Real-world trading decisions often hinge on how traders perceive market volatility and its potential impact on the underlying assets. By understanding Vega, you can better navigate these waters and make informed decisions. What strategies will you use to capitalize on volatility? The interrelationship of the Greeks. Understanding how Delta, Gamma, Theta and Vega work together is essential for anyone involved in options trading. Each of these Greeks plays its own role, but they don't operate in isolation. Instead, they interact and can impact your trading decisions. Creating a balanced portfolio. Tips on how to use the Greeks collectively to maintain a balanced options portfolio. To create a solid options portfolio, consider how these Greeks influence your trades. By using them together, you can manage risks and enhance your strategy. Here are some tips to help you keep things balanced. Monitor Delta and Gamma together. Delta measures how much the price of an option changes when the underlying asset moves. High Delta means the option price swings a lot with the stock price. Gamma shows how much Delta changes when the stock price moves. If you have a portfolio with high Gamma, your Delta can shift quickly. Keep an eye on both to avoid unexpected outcomes. Consider Theta when planning. Theta represents time decay, which means options lose value as expiration approaches. If you're holding options with a high Theta, be prepared for erosion in value over time. Balance your portfolio by including options with shorter and longer expiration dates to manage risk. Balance Vega for earnings reports. Vega indicates how the price of an option will change with volatility. If you expect a stock to be volatile due to news or earnings reports, make sure your exposure to Vega is well balanced. Too much Vega can lead to wild price swings. Diversify your strategy. Don't rely on one Greek alone. Combine different strategies such as spreads or straddles that involve multiple Greeks. This diversification can help balance the overall risk while capturing potential moves in the underlying asset. Use a risk graph. Visualizing your portfolio using tools like risk graphs is an excellent way to understand the interplay between the Greeks. It gives you a clearer idea of how changes in one can affect the others. Adjust positions regularly. The Greeks can change as the underlying stock price fluctuates. Regularly review and adjust your positions to stay aligned with your trading goals. Keep your portfolio in check so you don't overexpose yourself to any single Greek. By understanding how delta, gamma, theta, and vega interrelate, you can make informed decisions that lead to a well-balanced options portfolio. Consider these tips to help navigate your trading journey. Practical applications and case studies. Understanding how to apply options. Greeks in real trading situations can transform your entire approach to the market. Let's explore some success stories that highlight effective strategies using delta, gamma, theta, and vega. By learning from these experiences, you can grasp the real impact of Greeks on trading outcomes. Success stories and lessons learned. The delta advantage. A trader named Jenna focused heavily on delta when she analyzed her options. She noticed that a stock had a high delta, which indicated a strong correlation with the stock price. When the stock moved up, so did the value of her calls. Jenna learned to use delta to choose which options to buy and when to act. Her takeaway? Knowing delta helps you spot potential winners early. Gamma scalping. Tom was an options trader who mastered gamma. He implemented a strategy known as gamma scalping. This involves trading options that have a high gamma to adjust delta regularly. When the stock price moved unexpectedly, Tom was quick to buy or sell underlying shares to earn profits. His lesson? Gamma can be your friend in volatile markets. Theta Decay awareness. Sarah held short-term options and was well aware of theta decay. She timed her trades carefully to ensure she sold her options before they lost too much value. By monitoring how time affected her options, she made consistent gains when selling her contracts. The lesson here is clear. Keep an eye on theta to maximize profits. Vega sensitivity. Mike traded options in a market with fluctuating volatility. He realized that Vega influenced his profits significantly. By choosing options with high Vega during earnings reports or major events, he capitalized on price swings. His experience taught him that understanding Vega helps traders take advantage of changing market conditions. Combining Greeks in strategies. Finally, a group of traders decided to combine all 4 Greeks in their decision-making process. They created a diversified strategy. By evaluating delta for price movement, gamma for adjustments, theta for time decay, and vega for volatility, they minimized risks and maximized returns. Their success proved that using a holistic approach to Greeks can strengthen any trading strategy. These real-life examples illustrate how understanding and using Greeks can make a significant difference in trading strategies. Whether you're a beginner or an experienced trader, there are lessons to be learned from those who have effectively harnessed the power of delta, gamma, theta, and vega. Are you ready to apply these insights in your own trading journey? Mastering the Greeks for better trading decisions. Understanding options. Greeks is crucial for making smart trading choices. Think of the Greeks as the compass that guides you through the often stormy seas of options trading. Each Greek measures a different aspect of risk, and helps you predict how your options might perform. By mastering these indicators, you can fine-tune your strategies and boost your chances of success. Understanding delta, the first step. Delta shows how much an option's price is expected to change when the underlying asset moves by $1. It's like knowing how your car will react when you hit the gas pedal. Being aware of delta helps you anticipate market movements and make quicker decisions. Gamma, the acceleration factor. Gamma measures the rate of change in delta. Think of it like the acceleration in a car. If delta is your speed, then gamma tells you how quickly you're speeding up or slowing down. Knowing how delta and gamma interact can sharpen your decision-making skills in a fast-changing market. Theta, the time factor. Theta represents the time decay of options. Every day your options lose value as expiration approaches. This can feel like watching ice cream melt on a hot day. Recognizing the impact of theta is vital in deciding when to enter or exit a trade. Vega, the volatility gauge. Vega tells you how much an option's price will change based on the volatility of the underlying asset. Imagine the stock market is a party. When more people show up, higher volatility, the energy increases. Recognizing how Vega works can empower you to make bolder choices when the market shifts. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like and share to continue your journey to financial success.